Hello and welcome to Business Standards Morning Show. I am Ruchika Chatravanshi and let us take a look at the stories for today. Europe is now adding a million fresh COVID cases every 3 days. In the US, at least 190,000 new cases are surfacing daily. China's Sunday tally was at a 21-month high. And back home in India, active cases soared past 75,000 on Monday. The world is ringing in the new year with a sense of deja vu. And so is the hospitality industry, which was hoping to make up for its losses amid New Year revelry. Let us look at the current situation and what it means for the sector.
India's Omicron case tally reached 578 on Monday, although no death has been reported so far, and the active COVID-19 cases stood at 75,841. The trend is similar and the period too. The end of 2020 was also marked under the shadow of COVID-19, which took a deadly turn by March and April, claiming lakhs of lives. So as the world is venturing into another unknown territory, nations are taking steps to avert what is known to all now, the havoc that the pandemic can cause. WHO Chief Tedros Adhanom Ghebreyesus has summed it well: an event cancelled is better than a life cancelled. But amid all this, businesses and the livelihoods of crores of people are also being affected. The Federation of Hotel and Restaurant Associations of India estimates that over 20 to 30% of establishments in the organized sector, comprising around 60,000 hotels and 5 lakh restaurants, have already shut shop since the outbreak of the pandemic. On Monday, the center issued another set of advisory to all states and union territories, saying that they may consider imposing need-based local curbs and restrictions to control crowds during the festive season. Several states, including Delhi, Uttar Pradesh and Maharashtra, have already imposed night curfews. Mumbai civic authorities have banned New Year celebrations in closed or open spaces. Starting January 1st, Haryana is banning access to public places for both the unvaccinated and single-dose vaccinated. While dozens of countries have started giving booster shots, India will start administering them as a precautionary measure to healthcare and frontline workers from January 10th. It all has come at a time when the hospitality sector was steadily inching towards some normalcy. The earnings in the run-up to New Year would have given the sector a much-needed breather. Hotels have been seeing above-normal bookings over the past few months as revenge travel after the second wave unleashed the pent-up demand. But they now stare at cancellations due to increased restrictions. The government has also extended the suspension of scheduled international passenger flights till January 31st. Pradeep Shetty, Joint Honorary Secretary of FHRAI, lays out his concerns over this evolving situation.
The effect is already underway. We can see the effects. After the second round of the lockdown and the pandemic, I would say that the industry was growing at a good steady pace. There was a recovery of revenue earnings to almost about 70 to 80% in the holiday and in the leisure section. And in the cities and metro and the corporate hotel sections, the recovery was still about 40 to 50%. So this was a steady recovery. And starting this December, it looked like a promising new year ahead of us. A new year, as I think it's well known. In fact, it's known to all of us that December constitutes to a large portion of the revenues for a hotel or for a restaurant, standalone or otherwise. And that looks like to be completely in shambles right now. Every state after state is bringing in more and more curbs. The centers rust into issue advisories, although they have left a lot with the local administration, but there are advisories coming in from all corners. Every city, every district, every state is coming up. So what has really affected is the arrivals, the foreign arrivals, the tourist visas, all that have been deferred to next year. That's a big body blow. Then the New Year events have reportedly been cancelled in every state, more or less, except barring a few. Then there are restrictions brought back into the capacity of operation for restaurants at 50%. In many places like Delhi and Gujarat, there were no restrictions. They brought back restrictions. And even for wedding and other related events, there are now caps which are coming in, and permissions, etc., coming in. All of this looks like it has started affecting us already. It has started affecting.
So, what does the industry expect from the government? Shetty tells us.
We have estimated a figure of about 1.3 lakh crore of loss, of revenue loss for the industry, and of course for the country as well economically. So we are with the government. What we want is that definitely there should not be any shutdown. Don't rush into calling for shutdowns, because what happens is the moment all of this happens, the first axe falls on this industry on the pretext that there are people assembling here, people meeting here. So that should not happen. There should not be further clampdown, at least on the operation timings or on reduction of capacity. These two things should not happen. There should be greater emphasis on following the rules and COVID appropriate behavior, which we all will do responsibly. But any more curtailing of the number of persons in an event or a capacity of a restaurant, or bringing down the timing, is going to be very, very bad.
Contact intensive sectors like hospitality and tourism are always the first victims of a lockdown. India's domestic tourism saw a healthy uptick after August. Airports were choked and restaurants in tourist places were seeing a full house. December is the busiest period for hotels, with Christmas, New Year and the wedding season all coming together. So far, hotels have not seen large-scale cancellations as the number of active cases is low, but a further rise may lead to another round of lockdowns. In all of this, there could be a silver lining. A third dose of the Covishield vaccine significantly boosts antibody levels against the Omicron variant. Its inventors AstraZeneca and Oxford University have said. Covishield accounts for 90% of the vaccine doses administered in India. While there are doubts on the effectiveness of the booster doses, opting for a lockdown instead will not only stop the economic recovery but push more small businesses towards closure.
It is not just hospitality and tourism. The pandemic has cast its shadow on almost all sectors. The IT industry is also one of them. In a recent interview with Business Standard's Shurjit Dasgupta, Tech Mahindra CEO and Managing Director CP Gurnani shared his company's plans for growth amid the ongoing uncertainty caused by COVID 19. With half of its revenue coming from the telecom ecosystem, the IT major is now focused on 5G, software defined networks, and connected solutions. Let's listen in.
Morning, Mr. Gurnani. Obviously, the one main theme has been the COVID and its impact on the IT industry. So, how has that changed your strategy in terms of business?
As you know, TechM's 50% revenue is comes from the telecom service providers and the telecom ecosystem. And as you also would agree that there are really three factors which will help telecom grow. Number one is that most of the telcos realize that 5G will add value to them. Hence, they need to work on network upgradation. Number two is that newer platforms will drive consumption of telecom. And the third one, which is the most dominant part as far as I'm concerned, the more work from home happens, the more we all appreciate the importance of our network service providers. So clearly, three drivers: 5G and software-defined networks. Number two is 5G in enterprise. And number three is service providers upgrading their networks. And number four, digital platforms for telcos, I think is clearly an area of focus for us.
You were also a large player in the Open RAN space, especially with Rakuten, but you have sold off your technology company to Rakuten where you had a 50% stake. So, I mean, is there been a rethink on this space for you?
On the Open RAN, I would only say is that not that we have not abandoned the space. It is just that the number of players in this area has increased. And so it is no longer only Rakuten. I mean, Microsoft has come up with their own ecosystem. VMware has come up with their own ecosystem. And similarly, we believe that Mavenir has got its own ecosystem. So we are definitely committed, but to remain neutral, it was important that we are not seen as execution partner to one. So our strategy is we are not a product company, but we will execute with some of the leading players.
A lot of the telecom companies in India are basically building their own networks, like Reliance is building its own network in collaboration with various people. The more important way Airtel has tied up with the Tatas. Is that the model that you will go, or is that market more or less closed because they are only two big players which are there and which have already chosen most of their partners?
Clearly, telcos are looking at balancing their capex and opex. There is a new way of managing the networks, which has to be the theme song for the telcos. I don't think it is only about Tatas. It is basically what all the players are trying to do is find viable alternate proofs of concept at a certain scale and volume. And my belief is that we are execution partner to every player, including Airtel or a Reliance Jio.
One key problem which you always tend to face is the people problem. So how are you seeing this? I mean, how are you tackling this issue and what is the situation for Tech Mahindra?
And I can only tell you, Mr. Dasgupta, that it is an industry-wide issue. The consumption has increased from all three. Number one, the IT service providers. Number two is the global technology players themselves. Number three, all these startups, because they are all basically technology companies. And number fourth, even corporates, I mean, who want to play a role. So there is definitely a skill war or a talent war going on. We anticipated and we have now opened tier 2 cities, Coimbatore, Trivandrum, Indore, Nagpur, so Calcutta, Bhubaneswar. I mean, so our focus on tier 2 cities mean people will work from their preferred home locations. Number three, there are emerging markets like Vietnam or Bangladesh or the Eastern European bloc. I mean, we have now opened up our presence there also. So we're trying to, as a strategy, catch them young, train them, participate in their career development.
Do you have a plan where you want to get into being the top three? Because that number has sort of eluded you every time.
I can only say, Dada, I have not stopped dreaming and I have not stopped executing. So my job is to make my dreams a reality. I'll continue to dream, sir.
Okay, lovely talking to you.
Thank you, Dada.
Thank you very
Thank you
much.
so much.
From Tech Mahindra's growth plans, let us now move on to what is happening in the stock market. It was a choppy trading session on Monday. with the benchmark indices recovering sharply from their day's lows and then firming up in the latter part of the trading session. Year-end holidays across major markets and Omicron-related developments back home capped the gains. So what's in store for Tuesday? Here's a quick check on what you should be looking out for.
The key benchmark indices staged a smart recovery on Monday, helped by steady gains in private banks and IT shares. The Sensex gained 969 points from the day's low to settle 296 points higher at 57,420. And the NSE Nifty ended with a gain of 82 points at 17,086. Debutant HP Adhesives ended at 335 rupees a share, a 22% premium to its issue price of 274 rupees per share. Shares of RBL Bank hit a 52-week low at 132.35 rupees, slipping as much as 23.2% in Monday's intraday trade. After the bank said over the weekend that Vishwavir Ahuja, its managing director and chief executive officer, had gone on leave, and the Reserve Bank of India had appointed Yogesh K. Dayal as an additional director of the bank. The development saw most analysts sound caution as regards the road ahead for the bank and suggest the December 2021 quarter results may provide the much needed sentiment support to counter. The RBI too, on its part, allayed investors' fears, saying that the bank remains on a sound footing. According to the brokerage CLSA, the RBI's action will lead to uncertainty in the near term and will further impact multiples for the bank. We believe that with such a transition, bank with the RBI's permission should give more solid reasoning for the actions of the regulator, as minority investors are important stakeholders. Its second half results for FY22 will be the key in bringing about stability and comfort.
This bank, due to change in government in Andhra, they had huge NPA. So even if a new management comes, controlling the NPAs will be difficult. So at this point of time, I will avoid RBL because growth is not coming in the bank. We need to buy bank where growth is a possibility. So ICICI, Kotak Bank, HDFC Bank remains our top pick.
Over the next few days, given the trading holidays owing to the year-end celebrations globally, volumes, especially from the FII segment, are likely to remain thin. However, the key benchmark indices are prone to sudden sharp swings given the uncertain news flow on developments around the Omicron variant and the monthly FNO expiry. On Tuesday, investors shall eye the outcome from the SEBI meet. Some of the key points that may be discussed in today's SEBI board meet, according to reports, include increasing the lock-in period for anchor investors from the present 30-day norm, fixing a separate price band for wealth investors segment, and putting restrictions on the use of startup IPO funds for unidentified M&A activities. That said, analysts expect stock-specific action to continue as the week progresses, though the indices may still remain range-bound and prone to volatility. On Tuesday, shares of Supriya Life Sciences are likely to debut on the bourses. Supriya Life Sciences IPO received a strong response from all sets of investors, with a share sale being subscribed 71.51 times. The retail portion was subscribed 56.01 times and the wealth investors up to 161.22 times. The grey market premium is indicating a likely 40 to 45% listing gain for the stock versus the issue price of 274 rupees per share.
Apart from raising or pouring funds into the markets, companies around the world also spend heavily on research and development and reap the benefits of innovation too. The intellectual property rights give them the power to produce it while barring others from replicating it. But with humanity still in the dark about pandemic's future, should a few vaccine makers and countries cling on to their IP rights and deny generic firms the technologies to produce the vaccine at mass scale? A debate has been raging around this for a while now. Let us explore more about it.
On November 26th, US President Joe Biden called on countries attending an upcoming World Trade Organization meeting to set aside the intellectual property rights on COVID-19 vaccines. The November 30 meeting, which in itself was being seen as the test of WTO's relevance, was postponed due to the threat posed by the new COVID-19 variant. So now, a call on the intellectual property or IP waiver of COVID-19 vaccines will be taken by February end when all 164 member nations of the WTO converge in Geneva. While most of them want the waiver of IP rights, some don't. Public health experts have been saying that such a waiver would help developing and low-income countries get more supplies of vaccine in this time of crisis. Let us take a look at the proposal for IP waiver that is being considered by the world. So far, nearly 8.5 billion doses of the COVID-19 vaccine have been administered globally. But the vaccine distribution has been uneven to say the least. Just like other resources, poor nations have got a far lesser number of vaccines when compared to the rich countries. The figures say it all. According to Our World in Data, 56% of the world's population has received at least one dose of a COVID-19 vaccine. However, just 7.1% of people in low-income nations have received at least one jab. Low vaccination rates are seen as a big risk in the appearance of new variants. Many countries hope that a waiver on the intellectual property or IP of COVID-19 vaccine will help in mass vaccination. The trade-related aspects of intellectual property rights, TRIPS in short, is the international agreement between the World Trade Organization members that deals with intellectual property rights. The multilateral agreement has been in place since 1995. In October 2020, India and South Africa proposed a temporary waiver on IP rights for COVID-19 vaccines and other COVID-related technologies at the World Trade Organization until global herd immunity is achieved. This proposal has come to be known as the TRIPS waiver. The waiver would enable the manufacturing of generic versions of COVID-19 vaccines. It temporarily removes the protections provided by the WTO. About 100 of the WTO's 164 member countries have supported India's proposal, including the United States, which voiced its position in May this year. Several wealthy countries, including the UK, Germany, and Switzerland, as well as major vaccine-making pharmaceutical companies, are against the initiative. A decision on the waiver can be reached based on consensus of all 164 WTO members. If an agreement cannot be reached, the decision can be made by voting. A 3/4 majority is needed in order for the waiver to be adopted. Millions of people in poorer countries are yet to be vaccinated, while rich nations are looking to give booster shots to its population. Both need vaccines, and sharing the technology will only help in completely wiping the virus. While calling for IP waiver, the US has rightly said that extraordinary circumstances need extraordinary measures.
That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.